You back on the program. Thanks very much. How is price action looking to you? Put all of it together. You've got stocks which are broadly higher, inching up. Dollar which is sharply down. The dollar index is now down under 102. Oil prices are up. Many would argue that when it's essentially an asset class, and in the near term, oil going up is good news. I mean, it shows buoyancy more than anything else. Your sense overall, Dean?
Yeah, basically, let's start with the U.S. The setup in the U.S. is that both S&P 500 and the Nasdaq recently had follow-through days, which means in our methodology, this may be the start of a sustainable rally. So we are advising our clients to slowly add to positions. However, we are not in clear just yet, as we have to deal with resistance levels for both indices at the moving averages. For S&P, we're testing the 200-day DMA. And for the Nasdaq, we are testing the 100 DMA, and we still have to contend with 200 DMA on the Nasdaq. The next critical level for the S&P is at around 4,100, and if we can break above this level, then we have a chance for a positive trending market. The recent moves, of course, have been sparked by signs of cooling inflation. We've seen cooler than expected CPI print last Thursday. So I think things are looking fairly constructive. Now, when we look at the market currently in the U.S., we're encouraged by the breadth of sectors that are starting to show some signs of recovery. About 70% of the New York Stock Exchange are now trading above the 150 DMA, where this was only 40% back in mid-December and much lower in September. And when you take out the mega cap stocks, notably the so-called FANG stocks plus Tesla, the index is actually looking a lot better. Now, if I look at Asia, Asian markets like AAXJ or the EEM, they're all moving above the 200-day moving average, trading very constructively, and especially on the back of course, China reopening. And so I think that's good news overall for global markets. And I am seeing some, major fund flows or foreign investor fund flows into Asia. And then when I come back to India, the index is actually hanging in there fairly well. Like the Sensex is, currently testing the 100-day moving average. It looks pretty constructive. And so given some of these large companies, reporting this week, I think it looks fairly constructive here.
Okay, that's a good way to start the show and start the day, right? So you're saying that the 4,100 level on the S&P 500 is what you're watching out for next. So there's some more upside, and you're seeing India as a constructive market as well. On the Nifty itself, do you think the December lows of 17,770 or thereabouts is something that can hold through the course of the next few months? Because we've tested it once in the recent past. Yeah. What's your sense about the support level?
Yeah, I would say for India, it is currently testing, a major moving average. And if we lose that moving average, certainly the lows from December will come into play. And that will be a critical level because, if we were to break that level, then we're probably heading towards the 200-day moving average, which is about 4% below current levels on the Sensex. I think that is a very critical level should we breach the 100-day moving average here.
All right. Hi, Dean. Good morning. What about crude oil prices? I think majority on the street believe that it's going to be moving low. I think you as well briefly alluded to that. What's your sense? It's at around $85 per barrel. From an India perspective, that's rather important. We want it to cool off. So levels on Brent crude, if you have one, and also the dollar index. Yeah. Well, that's broken the 102 odd mark. So that's, encouraging from an emerging market perspective. I think you had a view out there as well. Go ahead.
Yeah. So for oil, on WTI, we're currently sitting at 78. We see next support at around 70. And resistance is only, at 79. So very close at the 50-day moving average. Currently in the downtrend. So let's see if oil can, find support at 70. But I mean, it's good news as, oil continues to, kind of slowly come off that allows economies to sort of reflate based on cheaper input costs. So that's welcomed. In terms of the U.S. dollar, we're at 102. We see next support level just below around 101.50. Resistance is going to be at around 103, but certainly in the downtrend, given softer inflation numbers coming through in the U.S.
Dean, the one big thing in 2023 as we start is what's becoming clear, and I don't want to sort of overemphasize it, but so far data does suggest that inflation, which was the big problem of last year, is coming off sharply, right? And perhaps it continues to do that. The next big data point is the U.S. labor market data, but that's only early February. And then, of course, we get the rate decision. On the rate side, the 10-year, for example, have we seen the peak is already behind, in your opinion, and we continue to head lower?
Yeah, that's a great question. I believe it is because when you look at the 2-year yield, we're currently sitting at around 4.2 in the market. The Fed fund rate is at 4.25 to 4.5, and they're talking about, if you look at the spot rate, they're planning to go as high as 5.25. But the bond market is suggesting to us that the rate pretty much has peaked. And when I look at J.P. Morgan's results, for instance, which is a major money center bank in the U.S., their underlying assumption is we may get 1 or 2 rate hikes in the first half, but they are expecting rate cuts in the second half. So I think that we're almost there in terms of peaking of the Fed's rate hiking cycle, and the bond market certainly is suggesting that as well.
All right, we'll leave it at that. Dean, thanks a lot for joining in, and all the best for the rest of the year. Of course, we'll keep speaking to you, but thanks for your thoughts today. So that's a positive and optimistic